on our last day for this scenario. For this one, we're going to look at a sales tax payable transaction. On March 8th, business XYZ sold $200 worth of their inventory at cost and collected $20 in sales tax. The effect on the balance sheet is a little different here, so pay attention. First, there is an increase in assets for $220, since that was the amount that was collected. But there's also a decrease in assets for $200 because that inventory is gone. Now you might be thinking to yourself, hey, these numbers don't add up. And my bookkeeping bosses, you're right. Because the $220 that business XYZ collected also has sales tax included, we need to increase our liabilities by $20, since that is what was put into our sales tax payable account. In other words, if you look at the balance sheet, you can see that cash has increased by $220, inventory has decreased $200, and we now have a sales tax payable account in liabilities, leaving business XYZ with $16,220 as the total for our assets and liabilities plus equity. Wow, this one was a doozy. Let's check in with an expert for some more advice.
Sales tax payable is a current liability normally on a balance sheet. So some of the common mistakes that new bookkeepers can make with making a payment on sales tax is they don't map the debit side of that payment to the sales tax liability account. I've seen it, and I'm not going to just blame bookkeepers. I've seen business owners do it too. So it's not just bookkeepers, but basically they'll write that check to the state, pay sales tax. And instead of choosing a liability account, which should already be set up, they are going to push it down to sales tax expense on the profit and loss statement. That is absolutely incorrect. You want to pay off the liability. So as there are sales happening that have sales tax activity, the sales tax portion of that sale should be pushed to a current liability account. And that will pool there until the payment is made and you debit that same account. So basically, if it's done correctly, you'll be crediting the checking account, which is an asset, and you'll be debiting sales tax liability, which is a liability account. And that affects the accounting equation. You know, we're reducing the asset by $10,000, but we're also, or not $10,000, whatever the payment is, but we're also reducing the liability account as well. So basically, the equity is pretty much staying the same in the business, and that's how it is affecting the accounting equation.